Alex thought his student loan repayment was finally under control. Then the email arrived. Action required. The save plan was over, and the message gave him 90 days from the date of the notice to choose another plan. If he waited, the system could choose one for him. He opened the calculator and saw unfamiliar names, a higher payment on one screen and decades of repayment on another. These were federal student loans. Before that clock runs out, 3 questions matter. Which plans can you actually use? What happens if you do nothing? And which option costs less over time? For a while, Alex had stopped worrying about his loans. His account had been quiet for months. No bill, no payment due. He had let himself believe the hard part was behind him. So when the notice came from his student loan servicer, part of him did not want to open it. The message was short. The plan he relied on had ended. He needed to review his other repayment choices. And if he did nothing, a choice would be made for him anyway. He clicked through and found a list of plans with unfamiliar names, each one showing a different monthly payment, a different number of years, a different total sitting at the bottom. He did not know which one fit his life. So he closed the tab and told himself he would deal with it later. The plan that had kept his account quiet was gone. The balance was still waiting. Before we go any further, one thing matters more than everything else, and it is the first thing you should check. This is about federal student loans. If your loans are private, meaning they came from a bank or a private lender and not from the government, none of these plans apply to you. Your terms are set by your contract, and you would talk to your lender, not a federal servicer. And even among federal borrowers, not everyone was in SAVE. And not everyone has the same choices now. The only way to know what you actually have is to log into your account at StudentAid.gov and look at your loan types and balances with your own eyes. Not a screenshot a friend sent you, not a video, your account. So, what happened to SAVE? A federal court order and an approved settlement ended the plan. Interest on loans in the SAVE administrative forbearance had already resumed before this transition began. Beginning July 1st, 2026, servicers started sending affected borrowers notices, giving them 90 days to select another eligible repayment plan. Here's the part people miss. Your deadline is tied to the notice sent to your account. It is not automatically the same date for every borrower. So one person's 90 days can end well before another's. This is not something to learn secondhand from a comment section. It comes from your servicer, and it belongs to your account. So, what if he just did nothing? It felt safer than picking the wrong plan. But here is what doing nothing actually means. If you do not choose a plan inside your window, you can be placed into one automatically, either the older standard repayment plan or the newer tiered standard plan, depending on your loans and when you took them out. And the payment the system picks for you may be nothing like the low SAVE payment you remember. It can be much higher. Silence does not protect your old payment. Silence just hands the decision to a formula. Doing nothing felt safer than choosing wrong, but doing nothing was still a choice being made for him. So let us walk through the real choices, in plain English, starting with the one built around your income. It is called the Repayment Assistance Plan, or RAP, and it became available on July 1st, 2026. The idea is that your payment is tied to what you earn. Under RAP, your monthly payment is a percentage of your adjusted gross income, somewhere between 1% and 10% depending on how much you make, spread across the year. You subtract $50 for each dependent you claim, and there is a floor, so even the lowest payment is at least $10 a month. 2 features of RAP are worth slowing down for, because they are genuinely different from the older plans. First, if you make your full payment on time and it does not cover all the interest for that month, RAP waives the leftover interest, so your balance does not grow while you keep paying. Second, if your payment barely dents the principal, the plan adds a matching amount toward your principal up to $50 a month. After 360 qualifying payments, which is about 30 years, any remaining balance can be forgiven. Whether that forgiven amount is taxed is not something to assume in either direction. Federal tax treatment can depend on the forgiveness program and on the law in effect, when your forgiveness actually happens. Public service loan forgiveness can be treated differently from long-term income-driven forgiveness, and state taxes can differ too. It is worth checking the current rules for your own situation instead of guessing. And one important limit to know up front. RAPE is for direct loans. Parent PLS loans and consolidation loans that contain a Parent Plus loan cannot use it. Here's an official example from the Department of Education. An unmarried borrower with no dependents earning $45,000 and owing $35,000 would have a RAPE payment of $150 a month. In that example, $40 of unpaid monthly interest would be waived, and the borrower would receive a $50 principal match. Those numbers are only an example. Your real payment depends on your own income, dependents, loans, and account information. On Alex's screen, RAP moved with his income. If his earnings changed, the payment could change with them. That felt flexible. It also meant the plan could follow his financial life for years. The other new option is the tiered standard plan, and it works in a completely different way. It is not based on your income at all. It is a fixed monthly payment, more like a car loan or a mortgage, spread over a set number of years. Depending on how much you owe, that term can be 10, 15, 20, or 25 years. The bigger the balance, the longer the term you may be given, and the longer the term, the smaller each monthly payment looks. That can feel like relief. But stretching the same debt over more years means more interest by the end. A smaller payment can create breathing room. It can also keep the debt in the room longer. One plan followed his income. The other followed a fixed schedule. Neither was automatically good or bad. They solved different problems, and choosing the wrong one for his goal could get expensive. Now, are RAP and tiered standard the only options? For borrowers with older loans, other choices may still appear. Income-Based Repayment, known as IBR, remains available for eligible borrowers, and it was not eliminated. Federal student aid currently says, new enrollment in pay-as-you-earn and income contingent repayment is available only until July 1st, 2027. Separate transition rules for borrowers already connected to plans that are being phased out extend into 2028. That is exactly why your loan date, your current plan, and your enrollment history matter so much. And there is a quiet catch that surprises people. If you take out or consolidate a new federal loan on or after July 1st, 2026, your menu can shrink down to just RAP and tiered standard, even if you had more choices the day before. This is why you cannot borrow someone else's answer, your neighbor's plan, your coworker's plan, a stranger's plan in the comments. None of it tells you what you personally qualify for. This next part is the one I would really slow down for, because it is where the money is quietly won or lost. When Alex compared his options, the plan with the smallest monthly payment jumped out at him, the way it does for all of us. But the smallest payment today is not automatically the cheapest decision over time. Picture a balance of $40,000 at an interest rate of, let us say, 6.5%. This is only an illustration, not any real plan and not your loan. Paid over 10 years, the payment might be around $454 a month, and you would pay roughly $54,500 in total. Stretch that same balance over 25 years, and the payment could fall to around $270 a month. Easier every single month, yes. But the total climbs to somewhere near $81,000. That is about $26,500 more for the very same original loan. The point is not the exact figure. The point is that the lowest monthly payment can quietly cost you far more in the end. The only way to see your real numbers is the official loan simulator on your account. Look at the monthly payment and the total. Both of them. There is one group who has to be especially careful here, and that is anyone working toward public service loan forgiveness. If that is your goal, The plan you pick is not just about the monthly payment. It decides whether your payments even count. Income-Based Repayment and RAP are plans that can count toward Public Service Loan Forgiveness, or PSLF. The tiered standard plan does not. And the months your loan spent sitting in the save forbearance generally did not count either. There may be one limited exception. Some borrowers who already have 120 months of qualifying employment may be able to use the Public Service Loan Forgiveness buyback process for certain months spent in an ineligible deferment or forbearance. Buying back those months has to actually result in forgiveness, and eligibility is specific to your account. Verify it through the official buyback process, rather than assuming those months automatically count. So, if you are chasing that forgiveness, do not guess. Log in, check your qualifying payment count, confirm your employer still qualifies, and make sure the plan you choose keeps you moving forward. Being at a qualifying job is only half of it. You also have to be in a qualifying plan. Now, some good news because there is a little. For a limited time, there is a student loan autopay interest reduction worth knowing about. If you enroll in automatic payments, the total reduction on your interest rate is 1 full percentage point, up from the usual 0.25%. According to current department guidance, this applies to eligible federal direct loans dispersed on or after July 1st, 2012. If you are not already enrolled, you need to sign up for autopay by September 30th, 2026. If you are already enrolled and eligible, the extra reduction is applied automatically with nothing for you to do. The benefit continues through June 30th, 2028, and you have to stay enrolled in autopay to keep it. A few conditions matter. If you are in SAVE, you first have to move into an eligible legal repayment plan. If any of your loans are in default, you have to return them to good standing before you can enroll. And keep this part straight. This lowers your interest rate by 1 percentage point. It does not erase 1% of what you owe. Before you authorize automatic payments, check the payment amount and the due date your servicer shows you. Then keep checking your account until both your repayment plan and your automatic payment status show as confirmed. Let me come back to Alex because by now, he had read most of this, and he still had not chosen. Every option had a trade-off. Every screen had another number. He kept telling himself that one wrong click would make everything worse, so he closed the page again, and then another week slipped by. If you have done this, you are not lazy, and you are not bad with money. A system with this many moving parts can make avoiding it feel safer than facing it. But the calendar does not pause for how any of us feel. The deadline on that notice keeps counting down whether the page is open or not. So here's the calm version of what to do, without the panic. Log in directly at StudentAid.gov, not through a link someone sent you. Confirm your loan types and your balances. Read the exact notice from your servicer, and find the personal deadline that belongs to your account. Use the official repayment calculator, the loan simulator, to compare plans and look at both the monthly payment and the total projected cost. If you are going for forgiveness, check that the plan you pick actually supports that goal. Check whether an older plan like Income-Based Repayment is still open to you. Look at whether autopay makes sense for you, and what conditions come with it. Save copies of every notice, application, and confirmation. Keep checking your account until the request appears as processed, because submitting an application is not the same as seeing the new plan confirmed on your account. Do not pay a debt relief company for access to programs that are already free. And for anything specific to your situation, contact Federal Student Aid or your official servicer directly. That last point deserves a real warning, because confusion like this is exactly what scammers wait for. You never have to pay a company to get access to a federal repayment plan. Every one of these options is free through your own account. If someone promises to erase your loans fast for a fee, or asks for your login, or pushes you toward a surprise link, walk away. The real options do not cost money to reach. They are sitting in your account right now. In the end, Alex did not find a perfect answer because there was not one to find. He stopped searching random videos for a magic plan and started comparing the actual options tied to his own account with his own numbers. It was not fun, and it was not easy, but it was his to decide instead of a formula deciding for him by default. The rules changed and he could not control that. What he could control was whether confusion made the next choice for him. The save plan ended. The debt did not. And the plan borrowers choose next may shape years of their financial lives. If your loans have been quiet, this is the moment to open the page before the deadline opens it for you.